Hey guys, welcome to another segment of Framing CPA brought to you by Atlanta Business Accountants. In today's segment, I'm just going to follow up on the prior video that we recorded last week where we discussed errors on a prior filed return, what it means for you, what it means for the tax professional, and what exactly does a tax professional have what kind of ethical responsibilities does a tax professional carry when finding these errors. And as I promised, excuse me, as I promised, I would share with you a way to save yourself a bunch of penalties in the process. If so, the scenario is like this: you come to a new tax professional, and basically you find out after they reviewed your prior filing that there was an issue, an error, a misstatement. And in other words, you owe more in taxes for the prior filing. You're not happy, and you understand that now you have to basically pay for the prior year. This probably also means that there might be more than one mistake. It could be several years of the same mistake, and worse, you understand that this current year you might have an additional tax than what you typically expect, because like I said from that video, things tend not to change much from year to year. So that just sometimes happens. Yes. Basically, well, let's talk real quick about accuracy related tax penalties. I did a whole video on all the flavors. We always joke about it. The IRS has so many different levels of penalties and interest. It's like Baskin Robbins, 31 flavors. Yeah, there's that many. But the ones that we really want to be wary of is, penalties for accuracy. And that's just something that really doesn't need to be paid, because what an accuracy related penalty is when your tax professional just omitted a large sum of income usually, and you get penalized 20%, in short, plus interest. So that's an accuracy related penalty. We discussed exactly how much that is in the prior video, and how exactly you get it. It's usually when you're misstating your gross income by greater than 25%, and the IRS sees that as like, wow, you made such a big a misstatement on your income tax, and it's accuracy related. So you don't want to fall prey to that. That's like basically missing a W-2 on your filing, or maybe you're skipping out on reporting some interest or dividends, portfolio income. It could have been a capital gain. It could be a whole host of things. You forgot to include a 1099 if you're self-employed, and so on. Remember that the IRS works on a matching system. And when you file your taxes, the IRS is getting your filing, but their computers are comparing it to these third-party filing as well. So your employer sends a copy of your W-2 to the IRS, obviously. Your brokerage sends a copy of the 1099-B. If you're self-employed and you're receiving 1099 NEC forms, these are also being filed by the person you were contracted with, and so on. So when you're filing, and the IRS has a computer software that is comparing your total, let's say, wages to all the W-2s that were reported. And if there's a mismatch, it'll issue automatically a mismatch notice, or what we call a CP2000. These are also called correspondence audits, and they're automated. Now, the problem with getting one of these is that the IRS, is a huge system. You can imagine how many people there are in our country. And so all of this is being processed through the IRS. So, millions upon millions of people are filing their returns annually, and there's mismatches of all sorts coming into that system. So for the IRS to spit out a CP2000 notice, or what we call a mismatch notice, it can take up to a year to a year and a half. We've seen in some cases later, if you moved or something like that, for that notice to reach the client. So here you are, you filed your return in 2022, and you're walking around all happy. It's mid 2023. Maybe you're already getting into 2024, and you get smacked with the CP2000, and all of a sudden you're like, wow, I owe more money in tax. And why am I getting this letter now? It's been over a year, a year plus since I filed my tax return. And now I'm getting this, it's usually like a 10-page letter from the IRS. It looks awfully scary. I have only 30 days to respond. I don't know what any of this stuff means. There's a lot of columns and rows and wording, and it's lengthy, and I don't understand tax law. That's why I have a tax professional, blah, 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 blah. Yep, that's basically what we're dealing with on a regular basis, especially when we get new clients that come to us with some sort of CP2000. That's typically what ends up happening. Just on a side note, if you do get a CP2000, you can automatically request for an extension to handle that matter, and you can call them at the number cited at the very top right-hand corner and request an extra 30 days from the IRS to address the matter. And sometimes it can be fixed rather quickly. Or you can just basically say, yeah, I agree with that. I did. If you understand everything and you just missed out a W-2, you can just, agree to it and pay and everything else. But sometimes it's not that simple, and there's steps that you can take to minimize the tax. So when you do going back to the point of the matter, when you do receive such a notice from the IRS, basically what that means is that there was a mismatch, obviously, that you owe more in taxes and you need to handle it. Okay, but that's considered, the IRS has made contact with you, okay? But in our scenario, you came to the taxpayer, to your tax professional, and they brought the attention, they brought it to your attention that there was a misstatement of tax and that you understated your tax liability, that you owe more in taxes. So, what you can do is right away amend the return ahead of receiving any communication with the IRS, and then that would be considered a qualified amended tax return. And if you do a qualified amended tax return, you will actually not be penalized this 20% accuracy related penalty because you've come forward and you've handled the matter before the IRS contacted you. So the key is to come forward ahead of time, and you will save yourself the 20% plus the 7% interest currently in just penalties and interest. Yeah. So you want to do this. If you do find a significant return, omission of income tax, of income, and further, if you owe additional tax, your best bet is to come forward. It doesn't necessarily mean that you will be caught because, like I said, the IRS works on a matching system, and sometimes the error is something that you've generated. Like, for example, your accountant looks at the books and the books show a much higher number of income, but that income isn't reported by any kind of 1099 NEC. That's pretty common because some people just do business, let's just say, as an S corp, right? So if you're organized as an S corp and you're receiving payments to this S corp where you're doing business, you're basically not supposed to get a 1099 NEC by the people that you do work with. Or in our example, we get income from all sorts of businesses, all sorts of individuals. We're not going to get a 1099 from all these people that we do their taxes, that we do their business filings. And we're organized as an S corp. For instance, CPA PC is an S corporation, so we're not required to receive 1099 NECs. We might get a 1099K for processing, but there'll be a lot of payments that are made that will go unreported. So that's a great example of how in a way we're self-reporting things. So it might never be caught, right? I can technically skip out on taxation if I was some unscrupulous individual, which I'm not, right? I play fair too. So basically, it doesn't always mean that the IRS is going to come around and catch you, because some things are just not traceable. That's the problem with the system. There's a lot of people that go not paying in the right amount of tax. And like I said in the prior video, we're the goalkeepers, we're the referees between the IRS, the state tax authority, and the client. So that's the weight that's placed on our shoulders. And with each passing year, there's more and more of that more weight placed on our shoulders to do the due diligence, because there's just so many laws and rules and exceptions to those rules that we end up having to make sure that everything's being handled properly, because many things will go undetected. Yeah, so that's pretty much it, guys. So if you do if you do come into a situation like this, and your new accountant finds some sort of understatement, just understand that by coming forward before the IRS contacts you, you stand to save yourself accuracy related penalties and interest if your misstatement was grossly negligent, and they define grossly negligent as greater than 25% of gross income. So you forgot, let's say, a large W-2 that constituted greater than 25% of your gross income. You're like, whoops, I better include that. I better come forward. Let me go amend this return. And that would be considered a qualified amended return. And if you haven't been contacted by the IRS just yet, that will save you that 20% penalties and interest of 7%. All right, this is Freeman CPA. This is Greg Freeman signing off for this week's segment. Hope this tip helps everybody out. Remember, if you like, we really appreciate that. And if you can, maybe share this video with somebody you know that may benefit from our advice. Remember, guys, our motto here at Freeman CPA is your success is always going to be our success all day, every day. Keep it real, and thanks so much for tuning in. We'll talk to you again soon. Bye.